Welcome to the Warlords of Wall Street. Well, the drama with the regional banks and the large money center banks continued today. Regional banks took it on the chin one more time. We had reported the other day that we had just picked up the DPST at $8.10 a share. We got stopped out at $7.69. We were courageous yet again. Ran back in at 7:30, and were fortunate enough to see it jump up when people began to realize that the story with SVB, as we said yesterday, it's not a systemic problem that's going to affect all the other banks. Their portfolio was unique, concentrated, and that disproportionately so. Most of their deposits were not insured because the average depositor at SVB was a Silicon Valley somebody, and their average deposit base was well over $2 million per account. That's not the average checking account that you'll find with folks down there at Wells Fargo or something. So we got in at 7:30, got out at 9.25. Where we lost a little, a 5% to start the morning, but we came back and made a 26% profit. That's how we like to try to do it if we can. We got out and we saw it retreat just a little bit. We'll just have to see what happens in the next day or two with this. Probably the biggest story, other than what we're seeing with the regional banks and Washington's response to it, which there's going to have to be more regulation for maybe some of these medium-sized banks, is that the treasuries were pulling back aggressively, based on the sentiment that the Fed is probably going to be a little hamstrung here about trying to bring certainly the 50 basis point bump that we were anticipating in a week or two. That most certainly is off the table. Now the debate rages is whether even the quarter of a point will be sacrificed at this juncture in favor of just sitting on their hands for a little bit to try to calm things down in the banking sector. It's a tough place to be. They're caught between a rock and a hard spot. Powell is. You still have, and we will know towards the end of this week, we're going to know what these inflation numbers are. The CPI will come out, and I just don't know if these numbers aren't down by 10 or 20 basis points minimum from where they were last year. If we're not seeing a marked improvement in inflation, I don't know how the Fed cannot raise at least a quarter of a point, despite their staring in the face of a loss of confidence in some of the regional banks. I don't know. I don't know what they can do other than maybe make it a quarter of a point and just hope that we don't have more problems with the bank. Other than that, I think everybody is really just waiting for the numbers. That's the shoe that has got to fall, and I think we're going to continue to see some shaky volatility up and down in the market. But overall, I think because the banks are a leading indicator for the Fed, that they may have already caused, with being so aggressive in raising rates the way they did, they caused the bank's portfolios to technically go underwater. If a bank isn't making a business loan, it's investing a great deal of its equity in treasuries. And imagine, if you will, a year ago, you spent $1,000 to buy a government bond that was paying essentially a half of 1% or 1% to maturity. Today, that very same bond that you could buy for the same $1,000 has a yield that's 4.5% and was, up until a couple of days ago, flirting with 5%. Now, that's a significant difference, and that's the problem that the banks have, is that they are required to market, as the phrase goes, which is, if you had a bond last year that was only paying, your dollar bought you a 1% return, and today your dollar buys you a 5% return, well, which bond would you rather have for the dollar? And that certainly, today's bonds make last year's bonds worth a lot less because there's a 400% difference in the interest that it pays. So this has an effect on the bank's portfolios. They otherwise probably wouldn't allow anybody to know that they were that far underwater on everything they bought over the last couple of years, that this Fed activity of jumping things up by 400 and some basis points over the last year has actually caused a financial issue on the books. Now, unfortunately, that was coupled with a great many people starting to come and look for their deposits. They wanted their money out of the bank. The rumor hit the streets, and it's a cause and effect. If you think the bank has liquidity problems and everybody runs over there to pull their cash out, then any bank would have liquidity problems. They're just not designed for everybody to line up and say, I want my money back. It doesn't work like that. And the Fed is not going to allow that to happen. The FDIC will not allow that to happen. The regulators are doing what they need to do, which is to make sure that everybody understands that there's nothing wrong systemically with the bank system, that you've just got a couple of outliers that got too aggressive with their portfolios and that they weren't as transparent as they should have been. And that's certainly the case with SVB. But that's about all that we have today. It's a very narrow field for news as far as we're concerned over here. And the only thing that matters is what the CPI is going to do and what the banks continue to do if they continue to stabilize here. That's about the tail that wags the dog as far as we're concerned. So with that, we will close with what we always close with. Be safe out there. Keep your powder dry. Take your profits where you can. Don't be greedy. Take your profits.